Look at this chart. You can see the market hits the level and reverses, pulls back, hits it again and reverses, then pulls back once more, hits it a third time and reverses. Now we have a clear support level forming. Price pulls back again. And this time, we get a fakey setup, a textbook smart money trap. Price fakes a breakout below the support, drawing in breakout sellers, then quickly snaps back inside the range. That's our signal. You can enter at the close of the fakey candle, place your stop loss just below the wick, and aim for the next logical target. Now look at what happened next. As expected, the market reversed sharply and moved straight in our direction. That's the power of spotting the trap before the real move begins. Look at another chart. The market pushed up, hit this level, and reversed, creating a key resistance zone. Price pulls back again, and as it approaches that level, a fakey pattern forms. This is where smart money sets the trap. We see an inside bar, signaling indecision, and then a breakout above it, which tricks buyers into thinking the market is ready to break higher. But here's the catch. Price quickly closes back inside the mother bar's range. That's the confirmation. The breakout was fake. Now that we've spotted the trap, we can anticipate that the price is likely to move down. The setup is simple. Enter at the close of the fakey candle, place your stop loss above the wick, target the next key support level. And look what happened next. Just as expected, the market dropped cleanly and hit our target at the next support level. Another example of how smart money uses the fakey to trap traders and take control of the move. The engulfing bar is one of the most aggressive reversal signals in price action, but it's also one of the most misused by retail traders. On its own, it's just one candle eating the previous one. But when it forms after a liquidity sweep or at a key zone, it becomes a clear signal of smart money stepping in. Engulfing bars show up at turning points, and when used correctly, they tell you that the previous move is done and the market is ready to reverse. But to use it with precision, you need to understand the two types of engulfing bars and what each one is really saying. A bullish engulfing forms at the bottom of a move, usually after a sharp sell-off. The first candle is bearish, showing selling pressure. Then, suddenly, the next candle is a strong, bullish bar that completely engulfs the previous one. This shift in momentum shows that buyers have taken control. But remember, it's most powerful when it forms after a stop hunt or at a fresh demand zone. A bearish engulfing forms at the top of a move, often after a strong rally. The first candle is bullish, full of buying pressure. Then the next candle erases that strength with a big, bearish move that engulfs the previous candle completely. This signals that smart money is selling into the strength and that a reversal is likely, especially if it happens after a liquidity sweep above resistance or inside a supply zone. To truly understand the engulfing bar, you need to go beyond what it looks like and focus on what it represents. It's not just one candle covering another, it's a shift in control. A moment when smart money takes over and traps traders who are on the wrong side of the market. Let's break it down using a bullish engulfing bar as an example. The market is in a downtrend. Sellers are in control. Retail traders see price dropping and start entering short positions. Then comes a small bearish candle. It forms right after the move down. It looks normal. It gives the illusion that the trend is still healthy, that there's more room to fall. So what do retail traders do? They jump in short again. They place stop losses just above the high of that small candle. They're confident the market is about to make another leg down. But behind the scenes, smart money is watching. They're not selling. They're waiting. They know the stops are stacked just above that candle. So the next move is precise. A big bullish candle forms and it engulfs the entire body of the previous bearish candle. In just one candle, everything changes. That's the bullish engulfing bar. A signal that sellers have lost control and buyers are stepping in with force. But what's really happening here? Smart money uses that small candle to bait sellers. They trigger their entries, wait for stops to build up, then reverse the market and take liquidity. Retail traders panic. Some close in loss, others flip their position too late. And while the crowd is reacting emotionally, smart money is already in, riding the move they created. That's why an engulfing bar is never just about its shape. It's about where it forms, when it forms, and who gets trapped because of it. Understand that, and you stop trading like the herd and start thinking like the pros. Look at another example. The market makes a strong move to the upside and hits a level, then reverses sharply. That rejection gives us a clear resistance level. Later, price pulls back again and breaks through that resistance. This breakout looks like a textbook